Good afternoon and welcome. I'll be sharing my global financial markets and investing thoughts and insights through the end of the second quarter of 2024. Before I get too far in, a few words for compliance purposes. Statements made during this recording are for informational purposes and are my opinions. They are subject to risk and uncertainty, some of which are significant in scope and by their very nature beyond the control of myself, WealthFactor, and farther. There can be no assurance that such statements will prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. So my call today is going to be focused on global equity markets in this part. I'll be doing two parts. A lot of my thoughts are the same as the end of the prior quarter, and so I will include a link to that and encourage that to be reviewed. I think most of the dynamics are the same in equity markets, but perhaps magnified. As I've been over the last quarter, as the magnification of those dynamics has increased, my willingness to realize to prioritize diversification over tax has increased, which is really the first time in as long as I can remember that I've felt motivated enough to prioritize diversification over tax in many situations. So I'll be intentionally sort of skipping over a lot of the stuff that I talked about last quarter. A little bit of overlap with the concentrations and valuations, just because that element did increase materially relative to last quarter. But let's go through it. So just a quick overview of performance generally, and I'm continuing to kind of draw this large contrast in how I'm displaying recent performance, looking at 2022 and 2023 specifically. That contrast being how large growth declined substantially and value didn't in 2022, and then really since then it's been this massive recovery of those dynamics. And through the end of 2023, that the performance for large growth and large value over that 2-year period was largely similar. But into 2024, we're seeing growth, performance generally exceed value in this now 2.5-year period of time. And as I highlighted in prior quarters, or specifically the last quarter, growth has outperformed value since 2009 approximately. So it's a very long and strong, now persistent outperformance for growth versus value. But again, I'll try not to reiterate too much from the last quarter that's repetitive. So this is the page that in part is an overlap from last quarter. Specifically in this top right is a graph I looked at I was highlighting last quarter, and last quarter what this is showing is the weight in the S&P 500 of the top 10 stocks. Last quarter it was at a record high of around just over 33%, and as of the end of the second quarter, that's now up to 37%. And so when you're buying an index fund today, the amount of diversification you're getting is far less than what it's historically been on average. And I think it's in number of stocks. The same thing can be true from a growth versus value perspective. And so I think it's more important than ever to be very thoughtful in portfolio construction for the purpose of intentional diversification. It's a little more subtle in looking at the graphs, but the bottom graph is showing the earnings contribution of the top 10 in the S&P 500. And so if you see a market capitalization graph, which the top is representing, versus an earnings graph, and you see one go up dramatically and the other doesn't go up in the same magnitude, that suggests that the valuations are increasing, and that's what's causing the market capitalization to increase. And so market cap or the price can increase for multiple reasons, increases in valuation, and then increases in earnings. That's the predominant two elements, and so it's important to understand and think about these dynamics. And so as valuations are driving prices of the top 10 largest companies in the S&P 500 up, um, and those are becoming more concentrated in many client or more, many investor portfolios broadly. I think it's more important. I think it's critical, actually, that investors be very intentional about creating diversity, proper diversity in their portfolio. And if this topic is of interest, I would recommend going back and listening to my, and again, I'll include the link, my prior quarters insights, which talk about this concept in greater detail and more dynamics, not just simply the 10 largest stocks in the S&P 500. So the next thing I'm going to talk about is something that's coming up more and more, and want to just sort of share some thoughts in advance, which is how we have a presidential election coming up. What might that mean to the economy, and maybe more relevantly to U.S. stock performance? And the short answer is nobody knows, and that's consistently the answer when you're trying to predict what might happen into the future. But what we can do is go back and look at data and say and try to say, okay, well, we've been through this before, maybe not this precise. Well, actually, technically, we've been through this exact presidential decision before. But we go through presidential changes and government changes structurally, consistently. And so, what if we look at the aggregate data, what might we expect in an election year? So this particular page is highlighting that 2024 is one of the best starts for stocks, and this data, it's in the footnote, but is only through May 31st of 2024, rather than most of the data in this presentation is through 6/30/2024. But generally, the point here is still the same: strong start uh, through the year relative, and one of the best periods in an election year. And then on the right side of this page, it's listing out, okay, in each of those election years that had a very strong start, did the final stretch of that year look like? Um, and for me, the only conclusion is, just because we've had a good start to the year doesn't mean, and it's an election year, doesn't mean we should be worried about performance through the rest of this particular year, at least specifically in regards to the fact that it's an election year. Uh, Also semi-relevant is this there's a lot of, I think, general perceived idea that one type of government is going to be better for the economy or a stock market in general. And so this is looking at within three categories: and who controls the government, Republican, Democrat, or a divided government. What does that look like from a returns perspective? And then, or sorry, on the top, economy as measured by year-over-year change in GDP, and then below that, how does the market do? And so, the short, there's perhaps some micro conclusions that would have, some statistical significance embedded in here, but I'm going to intentionally ignore those because I don't think they're useful for people today. And I think those that are um, have the tendency to react or make changes in the portfolio based on things like this, I want to be intentionally guarded against that concept. And so, but generally, regardless of whether it's Republican or Democrat, we've seen strong increases in the economy as measured by GDP, and then also that's also been the case in regards to the increases in equity prices. I do think it is sort of interesting, and so I will highlight one micro point, that a divided government has produced weaker results relative to a single party control government. Um, However, if you think about this relative to the U.S. compared to all other countries, I think the fact that we have a system that allows for these three different scenarios to play out is probably there's probably a pretty strong net benefit over the long run, thanks to this system. So that concludes my comments that are for this particular quarter. I would welcome the opportunity to answer any questions or dig in on any topics that you think are relevant that I might not have covered.